Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG, and on behalf of KPMG and Airline Economics, I'm delighted to be joined by Greg Lee. Greg is the Global Head of Transportation Banking with Goldman Sachs. He's joining us for the purposes of our Aviation Leaders Report 2024. I should say we're recording this in New York in mid-October. Greg, thanks again for joining us for the chat. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about the role Goldman Sachs plays in aviation finance?
Sure, thank you. And thanks so much, Joe, to you, KPMG, Airline Economics, for inviting me to participate this morning. So Goldman Sachs has had a long history in working on everything from strategic M&A transactions to large financings for our clients in aerospace, airlines, and of course the leasing companies. And we've been fortunate enough to have been involved in some of the more significant transactions over time.
Great, and maybe we'll start, Greg, in looking at airline performance. You know, when we spoke last year, we were looking at a US, European strong bounce back, expecting to see the same come through in Asia in time. How have things gone on the airline side over the last year?
It's a great question, because what we're seeing is almost a tale of two cities. Some of the larger airlines who have big, significant international operations, premium business, long haul, have been doing it a little bit better than the airlines who have more of a domestic and low-cost carrier model. And so what you've seen recently in the most recent series of earnings calls has been a divergence between premium end of a cabin and the lower cost side of the cabin. So overall, I'd say that we're still doing extremely well as an industry, but the big bounce back we saw last year has been sustained to some degree for the bigger airlines, and it's been a little bit weaker for the low cost and short domestic haul airlines.
And would that be true US, Europe, Asia, or are there changes in that kind of trend line globally?
I think it's generally true for sure in North America. I think that you see a bit stronger performance in Latin America. Europe, it's been a little weaker in both the front end of the cabin and the back of the cabin. Asia is interesting because we're still waiting for a big reopening of international from China, but traffic patterns around China have been reasonably robust, and that's a market where the proportion of short domestic has been always bigger than international long haul.
And if we look at that airline performance, how concerned are you from a macroeconomic outlook perspective? You know, we hear some chatter around maybe US recession coming next year, and US arguably better placed than the rest of the world. So really interested in your views on that macroeconomic outlook.
So of course, putting aside big geopolitical shock event, which obviously is relevant and ever present, we are concerned about both rising commodity prices, so that's crude oil. In particular for the airlines, the crack spread, which is the price of distillate, has been stubbornly very high. So jet fuel prices for the airlines, unfortunately, are expected to be pretty high, and we've had a couple of earnings calls this week. More will come next week, where airlines are saying that jet fuel prices are a real headwind for their performance. So one macro comment is around commodity prices. The other is where rates are. So interest rates rising is a potential tax on the entire economy. Airlines, who obviously are very capex heavy, I think will disproportionately have to deal with just a higher funding cost environment. So I'm concerned about that. In terms of the engine for the airline sector, commercial aviation traffic, consumer spend has actually been pretty strong, stronger than expected. It's one of the reasons why our chief economist at Goldman, for example, continues to believe that, for example, in the United States, the risk of recession is still relatively low. We're pegging that at 15% as of now. There's a lot of risk around that.
Is that on a 12-month go forward, Greg, or what kind of go forward they do?
That's for 2024.
Yeah.
Yep. Good question. So we think that because we're relatively bullish on the economic environment, we're a little less bullish on the market environment. So counterintuitively, other forecasters who believe that there's a bigger risk of recession are a little bit more bullish on the markets because they think the central governments and the Federal Reserve equivalents around the world would act, for example, becoming more dovish and maybe even cutting rates, which would be a stimulant to the markets.
And maybe we'll hone in on that rates piece for a second, and before we get to what it means to the leasing community, your outlook on rates, is it higher for longer? Do you think this is the environment we're in for a reasonable period of time?
Yeah, we've been calling for a while for some of the rates that you're seeing, particularly the long end. Although we do think the long end, where you're seeing 5% 10-year US dollar rates, there's going to be, we think that comes down a bit, but we don't think we're going to be seeing a return to what we saw in 2020, 2021 anytime soon. So higher for longer for sure. And the risk around that particular prediction is around the economic GDP forecast, as we've talked about, and whether or not that GDP forecast actually ends up in the central government's actually doing something around rate policy.
Yeah, I suppose it's that counterintuitive piece where people wouldn't mind lower interest rates, but that probably means a recession is imminent.
Correct.
And maybe if we move on to the metal and supply side, Greg, I guess that a lot of the challenges we're seeing, maybe we'll separate OEMs and engines, but your thoughts on how challenging that supply side is for the wider market, taking in both the lessors and the airlines?
So there's been a lot of discussion around, hey, supply chain problems are probably good for aircraft leasing and maybe good for airlines because it reduces supply, reduces competition. Maybe the airlines can control the price of their product more. I do think all of the elements of our global aerospace supply chain do want and do need a healthy aerospace supply chain. So the OEMs, from the airframe to the engine to all the component manufacturers and the service providers, really, really important for the entire sector for that to be healthy. Today, we're obviously seeing significant supply chain disruptions. We think at Goldman, these things will be worked out over time. There aren't structural problems. It's a matter of time to figure out how to fix certain very specific areas in fuselage and engines, and over time we think that does get addressed. Near term, for sure, supply chain problems are increasing rent, they're increasing residual values, demand is very strong for both aircraft and engines in the secondary market. So it's probably a near term net positive for leasing companies.
Yeah, and your thoughts on that secondary market? It would seem that with those supply side challenges, that while yes, if you have lift and it's coming off lease, you're probably not in a bad place from, as you said, the uptick in LRFs or residual values, but it probably is leading to a slightly dysfunctional trading market where we're not seeing a lot of portfolio trades. Is that kind of following through on what you're seeing?
Yeah, I totally agree with that. I think the secondary market, and you can see this from some of the, for example, AerCap earnings calls, Air Lease earnings calls, the trading has been strong, but there are two sides to a trade, and so maybe the number of buyers who are interested in buying your aircraft is going to be a little lower. The number of financial buyers, given higher interest rates, is definitely lower, and so the best buyers of aircraft are, generally speaking, other big strategics who have balance sheets, access to investment grade debt. So whereas values are higher, the volume is lower.
And we've seen a slight trend of probably airlines with the cash they've generated maybe being increasing purchases of aircraft where they weren't obviously kind of coming out of COVID. Do you think that's a trend line that is material, and might we see it continue?
So lease rate factors and interest rates have been, interesting correlation over time. Definitely a lagging relationship. We think that supply demand is a bigger determinant for where lease rates are headed, as opposed to actually fundamental rates, which should be a huge cost of goods sold input into the calculation of a lease. Was talking to a client the other day about how if the last 3 or 4 years the unlevered IRR of an aircraft lease was maybe 50-60% comprised of a residual value, and so 40 to 50% comprised of the cash flows over time, net cash flows over time, that balance is shifted, right? So higher rates, not good near term for leasing companies. Over a medium term, should increase lease rate factors, hopefully enough to cover the cost of capital. But what's interesting is the proportion of the IRR that's now coming from residual value, this particular client was noting, was much, much higher, right? So to the point earlier around residual values, more trading values being higher. So inflation, right? We haven't seen inflation in a significant way really in the last 25, 30 years. So if inflation really comes back and results in higher residuals, that's a significant offset to the lagging impact of the lease rate factors.
Yeah, and I guess you can then end up in a funny situation where if you have a long lease life on the majority of your book, you're probably in a slightly worse position now at that lease encumbered asset.
Right.
So yeah, I think that's a very interesting dynamic that we're going to see. If we can move on to maybe the debt markets, Greg, and your perspectives. Look, we've many pillars across aviation finance, whether that's traditional banks, the alternative lenders, the capital markets, and maybe structured product. Your thoughts on the health of the overall market. So if you're a leasing group now and you're going to the market, and let's park maybe you're not an IG rated lessor for a moment, what are your best avenues?
I think one of the reasons why we have seen a fair amount of M&A activity and where we think there may be further M&A activity is in part driven by the difficulty of accessing debt markets. So similar to what we've seen in other sectors outside of this, of transportation, consolidation scale is really important for a lot of reasons. And one of the reasons, of course, is the efficiency of your liability side of the balance sheet. So if you're not an IG lessor, you can go to the bank market, and so if you have a nice lease with a good credit, a young aircraft, you're likely to get pretty decent financing. The competition for tier 1 airline credits is fierce, and so lease rate factors may not be very attractive from a lessor's perspective. The ABS markets, unfortunately, are still not fully functioning. There's a little bit of a private placement market, but again, the private placement market is very dependent on the quality of the underlying lessees, age and youth of the aircraft, structure of the lease. So the options for a lot of the sub-investment grade leasing companies is pretty limited. So what have they been doing? They've been doing warehouse financings, hopefully buying time for another market where hopefully rates are more constructive. Other leasing companies have been determined to stay the course and take near-term hits to their P&L with higher interest rates so that they can get to an investment grade rating. So the rating agencies and more importantly the capital markets writ large want companies who have big balance sheets. Scale is super important for leasing companies in the ratings world. So if you want to get to IG, you need to be a certain size. So we're seeing leasing companies either continuing to try to get to that size. It's near-term costly because they have to borrow at higher rates. But if they can get to that IG rating, that's going to unlock a lot of value, and hopefully they can then recover some of the losses.
And that's really interesting, and that scale piece, as you say, feeding into that importance. What is scaled, right? So if we look at some of the transactions that have happened, Standard Chartered nearly closed now, Goshawk, AMCK, it was kind of that 100 to 150 aircraft, 4 billion odd, right? 3 to 4 billion balance sheet. Is IG double that? Is it 6? Is it 7? I know it's not a cliff edge, but your thoughts on getting scaled to be IG rated, what does that look like?
It's a good question because that's changed over time. Yeah. I think that both bondholders and rating agencies have gone from kind of, a couple hundred aircraft, something in the mid single billions of dollars, maybe 5 billion, 6 billion, where it's a little bit more eye of the beholder. So scale is also the number of aircraft. So if you got to a large size because you had a lot of brand new wide bodies, that's probably less interesting to
diversification, really, isn't it?
Diversification, absolutely. So we think that today to get to IG, and this is not the only criteria for sure, but one directional data point would be something like 7 billion area and a couple hundred aircraft. So again, diversified, like you said, Joe, and making sure you had lease maturity diversification, making sure you had type diversification. And the other thing, of course, is track record.
Yeah, so that management team and what they've done over time. Can you talk to then maybe one area that we've seen as a trend line, and we touched on it last year, is the alternative lenders. So maybe plugging some of that gap we talked about with the non-IG crowd. Do you think that is a material part of the market now, and do you see it growing further over the next while?
I think that there's still a gap between where the alternative or private credit sources of capital need to earn their cost of capital and what economically makes sense given the low lease rate factors. Right, so I think there's still a gap which has prevented alternative capital from becoming a bigger part of that market. And a lot of the ways that leasing companies have been able to fund themselves has given them enough flexibility. So some of their warehouse financings have given them enough flexibility so they can buy time, so they don't have a gun to their head in order to so that they're not forced to do something that's more expensive than their lease rate factor. But so far, it's still been a smaller part of the market than I think that they would like it to be.
Yeah, so still slightly niche, but we will see.
Yeah.
And maybe looking at aviation as an asset class or aircraft as an asset class, we've often talked over the last few years of the maturing of the sector, and that's been helped by more IG rated lessors, and we've always had a limited number of public lessors, which has maybe hampered us slightly. Your thoughts on where aircraft sit as an asset class now? COVID, arguably outsized impact in aviation, Russia outside impact on aircraft leasing. So challenges that have come up, do you think that's hurt us as an asset class?
I think that and I'm glad you made the distinction. I certainly remember a time not too long ago when there weren't many issuances of regular rate corporate debt for aircraft leasing companies, and now there's quite a big number of investment grade issuers who issue bonds, secured term loans, and that market's become bigger and bigger. So that's very good, and that's sort of a public market in the sense that 144A debt, broadly distributed. There's some fixed income research coverage, but on the equity side, you have a couple listed folks in Hong Kong. You have a couple of listed folks in the U.S. I do think that the market has been hurt by headline risk. So COVID obviously was initially very, very scary, and then Russia was very scary, and I think that's limited liquidity. And so if you look at the price to book ratios for where these companies trade, in general, there's a couple exceptions, in general, they don't trade in a way that's consistent with actually their return on equity. And why is that? You could definitely point to relatively limited public appreciation for the sector, which just reads the headline and thinks that it's more volatile than it actually is.
And your thoughts then, if you go and compare as an asset class to others, when you see the IG rated lessors go to the bond market, rates are higher than they were a year ago or 2 years ago, we know that. Spreads that the IG rated lessors are achieving, are they comparable with other maybe transportation asset classes?
I think that our sector is blessed with a fair amount of efficiency. So in as much as the public markets, the public equity markets, may not have a full appreciation and therefore focus on our sector, I do think that airlines and leasing companies do get a fair amount of attention from financial institutions because it is a big, heavy CapEx market with a lot of visibility on supply every year. And therefore, the markets, I think, are pretty efficient. So the kind of spreads that leasing companies can earn versus railcar leasing, for example, they're comparable / a little bit better for a slightly weaker underlying lessee credit quality compared to other sectors like container leasing, for example. I would say it's also comparable. The ROEs that the public container leasing companies have been able to achieve have been maybe a little bit better. There's been more consolidation in that sector. It's also smaller. Both of those sectors are pretty small compared to aircraft leasing. Most of the alternative investors that we talk to that think about aircraft leasing versus other transportation assets or infrastructure assets, have reported that they think that the risk-rated return for the business is superior to most other asset classes they've seen. Like real estate, infrastructure, specialty finance, and that is mostly due to the lower volatility of the cash flows than it is the absolute spread on the cash flows. So in other words, they'll say, gee, this is a double B return for a triple B credit. It's not a single B return. It's not that lucrative a spread, but the risk rating should be triple B, and so that makes it appealing, at least historically, to alternative investors.
Yeah, and the nature of investors we see coming to aviation finance, have you seen any interesting trends in that, or is it still the same types of investors, albeit the names might change?
I think that what we've seen over the last 2 or 3 years has been a reduction in investors, because as the risk-free rate of return goes from like close to 0 to now 4s and 5s, it's a lot harder for an alternative investor to come into our sector and say, gee, I want to buy an unlevered aircraft lease at a 7 or 8% IRR when they can buy a AAA mortgage at 7%. So trend line for investors, at least today, given the rate environment and the alternative opportunities out there, the number of investors has definitely decreased. The alternative investors, the alternative asset class managers are pausing. You're seeing, therefore, strategics getting bigger. With a couple of rare exceptions, most of the activity for buying aircraft, whether portfolios or in an M&A context, are going to come from strategics versus new capital coming into the sector.
Yeah, and maybe we'll go into that point then around consolidation and the pieces you mentioned. Your outlook is potentially more consolidation, coming back to that kind of scale piece we've talked about.
Yeah.
Do you think we will see more decent-sized M&A over the next 12 months?
I think you're definitely going to see a lot of leasing companies explore strategic options. It may not result in a big M&A process, and I think it's going to be driven by, your classic board-level analysis of, here's my standalone case, here's my assumption for funding over time, and unless you have an IG rating, it's hard to model a business plan where you're going to be able to achieve a decent enough spread based where lease rate factors are today and your cost of capital. Therefore, I do think that you'll see more leasing companies at least explore whether or not a combination or a sale adds more value to their shareholders. So that could change. We could see a recessionary environment. You could see the Federal Reserve maybe pivot on rates. You could see markets rally like heck. Maybe the ABS markets come back. Things like that might change that prediction. But right now, we do think that, based on what we see today, it's more likely than not you'll see more consolidation.
Yeah, and that's the thing. It's probably, as you say, existing companies coming together rather than new capital coming to kind of build something out. I know we've had some exceptions, maybe on the sovereign wealth side in the recent months. Looking at big picture leasing, Greg, when you kind of look at the trend line for leased assets, 20 years it kind of ticks up, and there's certain spikes that happen. It rarely goes down, and we probably saw that tick go from probably funding somewhere in the mid-50s of new deliveries over the course of COVID, when balance sheets were really stretched. Your perspective on where that might go? Airlines are generating more cash. Do they appreciate the benefits and flexibility and support the lessors gave, and that channel continues to grow, or 50, 55 is kind of where we're topping out?
So it's interesting, because if you look at other asset classes, say in hospitality or retail on the real estate side, you've seen the proportion of assets being leased. Containers is another area where the proportion keeps going up, and the reason is not because of the cost of capital. So, some of the best, strongest balance sheets in the world are big shipping companies who will lease their containers, even though their cost of capital is a lot cheaper than, say, some of these sub-investment grade container lessors. So why is that? It's flexibility, right? It's being able to manage their own capacity at different points in time. It's logistics. I think in our space too, you see that a bit. Some of the better quality airlines do lease from time to time. So I don't think there's a structural cap at 50-55%. I think it's really very idiosyncratic to the airline, and now because of supply chain issues, which you talked about earlier, you might start to see just availability of slots starting to dominate what the airlines do in terms of their own fleet management. So, interestingly, Airbus and Boeing, if they are starting to think about how they allocate their slots, the precious delivery slots today, to leasing companies versus airlines, that could have a big impact as well on how airlines finance themselves.
Yeah, and they've always been relatively careful about that lessor exposure piece in managing it. I know when we have lessors sitting in that seat, we get some gripes on that front from time to time. Maybe shifting gears, Greg, and looking at ESG with a focus on the E, and obviously a significant challenge for the sector, but maybe honing in on aviation finance. Are we seeing an impact on the ability to attract equity or raise debt that is linked to the carbon emissions of your fleet?
I think it's coming for sure. I think that you're starting to see more and more investment committees at the banks express strong opinions around the percentage of a portfolio which is considered new tech versus old tech. So that's important. Leasing companies themselves also are starting to express and articulate policies around incremental new assets as opposed to renewals of existing assets, but incremental new assets having a certain percentage of new tech. I don't think it's been a significant hindrance for owners of older aircraft so far, but you can definitely see, Joe, the trend line moving in a certain direction. And that's going to be interesting because I think what the industry will show is other capital will start coming in, maybe the alternative capital will start coming in to the older aircraft because return opportunity may be there.
Yes, I think it's just an interesting one to watch, as you say, over the coming months and years. Just in closing, Greg, as we look out into 2024, and I always like to close with this question, what are your optimism levels like?
So we're pretty optimistic about the fundamental underlying economic outlook. We think that consumer growth, thankfully, consumer spending is going to continue to be pretty robust. We think that even though there's a little bit of divergence in certain major markets in the airline sector between, say, domestic, short haul, and international, overall the demand picture is a lot stronger than we could have possibly hoped for 3 years ago. So feeling pretty optimistic about airline health. We think that eventually the OEMs and the supply chain will be able to start to address and fix the supply chain problems which have plagued the sector. And the leasing industry itself has been incredibly resilient. It's amazing the difference between underlying performance of leasing companies over time and, say, commercial airline traffic and commercial airline performance itself. So always been very optimistic about that sector as well. And the markets are efficient. So as there's more consolidation and there's less competition, the leasing companies will be able to charge more, control their the price of their product a little bit better. And then what will happen at that point is, after a lot of consolidation, new capital will come in because they'll see opportunities to do smaller deals and maybe for older aircraft as well. So I think the markets are pretty efficient. The big question, of course, Joe, is what's going to happen with geopolitical risk, Middle East, Eastern Europe. It's hard to model that, but overall we feel pretty optimistic.
Well, on that hopeful note, Greg, on behalf of KPMG and Airline Economics, I'd like to thank you again for your time and insights and wish you and Goldman Sachs a very successful 2024.
Thank you, Joe. Thank you very much. Appreciate it.